A very good evening, friends. I'm Sanjeev Singhal, Central Council Member, Chairman, Auditing and Assurance Standard Board, and Chairman, Sustainability Reporting Standard Board. On behalf of the Auditing and Assurance Standard Board, and on behalf of my Vice Chairman, CA Vishal Doshi ji, I welcome you all to this webinar on communicating the CAM in the Independent Auditors Report and Auditors' responsibility relating to other information. Friends, these two are very important auditing standards. And this is our webinar series, which we started in the first week of April. And we'll be covering all the auditing standard by 15th of May this year. There's been an overwhelming response. Overall, this is the 28th program. 18 program on bank audits were done in March. And this is the 10th webinar on the auditing standard. And on an average, about 3,000 members in every webinar. So far, also more than 1,600 members have already joined. Friends, the importance of auditing standard is known to all of us. They act as our insurance. Why? Because our best defense is if we have followed the auditing standard. And what better standards than SA 701 and SA 720 revised? See, CAM has been mandated in case of listed entities to communicate certain matters which are important in forming an independent auditor's opinion. Sometimes we mix it up with the qualifications or emphasis of matter. Please note that CAM is neither a qualification nor an emphasis of matter. It is one notch below an emphasis of matter. So you don't want to emphasize here anything. You don't want to qualify here anything. You're just explaining the key issues which you would have encountered and how you've dealt with the same. If there is no CAM, then it is assumed that there were no such matter which the auditor wanted to bring to the attention of the users of the financial statement or to the shareholders of the company. SA 720 puts a very important responsibility to the auditor. This is basically to corroborate information in the financial statement with the other statements which are a part of the annual report. For example, the director's report. Tomorrow, it should not happen that something is there in the financial statement and the corresponding financial information given in the director's report is not matching with it. And say, for example, in the financial statement, a company is making a claim that the position is very good and no impairment testing is required. Whereas in the director's report, the directors are saying that the future is gloomy. The creditors are not. The creditors are asking for money, but we don't have anything to pay. The debtors are not paying. Sales orders are being cancelled. So then, obviously, I mean, if an impairment testing has not been done, then these two things will be contradictory. So an auditor is well advised to corroborate the information given in the financial statement with the director's report and other pieces of information which are there in the annual report. So these two standards form the cornerstone of an auditor's report. And I'm happy to share that we have two very renowned speakers from the Western region today, CA Amit Pundia and CA Padmashri Cresto. I thank both of them for joining us today and would request them to kindly take up their session one by one. Who will be speaking first, Amit, or is it Padmashri ji? Thank you for joining, and I invite you to kindly start your deliberation. Thank you.
I'll be taking up first, sir. Thank you so much, Chairman, sir, and as well as Vice Chairman, sir, for providing the opportunity to speak at the central level. It's rightly mentioned by you that this is a very important standard, and from the time it has come into effect, it actually has formed part of reporting, and it is developing, evolving over a period of time. I will just share the screen. Are you able to see the screen, sir? And hear me as well?
Yes. Yeah, we're able to see the screen.
Sure. Thanks, sir. So here we are to discuss very important standard, which has been recently, not very recently, we are sitting in the 4th to 5th cycle of implementation of this standard. ICI has also provided us enough material to implement this appropriately and successfully. One very important thing that Chairman Sir mentioned is that CAM is not an qualification, neither it is emphasis of matter. It is one of the important matter that we need to bring it out in our auditor's report. So please remember that, because that is the core of everything. One of the things that in few of the regulatory review reports that we have seen is that they have been mentioning that whatever is in the sequence or order of reporting has to come appropriately. Qualification cannot be diluted and made to an EOM. CAM is similarly not a substitute to qualification or EOM. So we have to remember that whatever is a CAM, and whatever is an emphasis of matter will always be emphasis of matter. So we will look at few of the things under CAM. One is definition of CAM, step-by-step approach for determination of CAM. What are the factors that we should consider at each stage of this step-by-step approach? Few of the examples of typical CAM. So little bit on CAM writing, basically how to write, what to write, and how much to write, and few other considerations while we are deciding on CAM. So what is key audit matter? Those matters that in the auditor's professional judgment. So it's a professional judgment is the base or is the parallel lifeline which we actually place reliance on, because professional judgment doesn't come overnight. It has to be inculcated by experience. And what is professional judgment? What is the decision in a certain situation is the professional judgment that varies from time to time. So it is a matter in auditor's professional judgment which is of most significance in the audit of financial statements of the current period. So two things here. One, the matter is most significant and it is relevant to the audit of the financial statements of current period. It doesn't pertain to previous period, it pertains to current period audit. Key audit matters are selected from matters communicated with those charged with governance. We all know that as per standards of auditing 260, there are standard matters that we have to communicate with those charged with governance. So there will be a list of issues maybe at the end of the audit that we want to discuss with TCWG. Out of that list, few of them or one of them may be a CAM, not necessary all of them will be CAM. So it is selected from the matters that will be communicated with those charged with governance. The effective date, we all know it was from period beginning on or after 1/4/2018. We are today in the 4th cycle of implementation of CAM in the audit report. So what are the requirements for communicating CAM as per the standard? The requirement is basically, it is stemming from the auditor's report. It is stemming from the intention to enhance the value of the auditor's report to users by providing greater transparency about the audit which has been performed. So what is the standard trying to tell us here? There will be matters which will be qualification, which will be emphasis of matter. However, there will be some matter which will be so much important or which is of higher significance, where we exercise maximum of our professional judgment and which we want to bring out in our audit report, which is useful to the readers of the financial statement. So what are the factors that have led to the creation of 701? Basically, few of them is like, establishing a focus on how the CAM affected the auditor's approach to the audit. So there may be certain things in an audit which actually changes the way that we strategize our audit or we plan our audit. So either at the beginning or during the audit, this may be matters that are actually at the beginning of the audit, during the audit plan we know, or during the audit, it is a matter that is identified as a significant matter. Particularly those matters that actually, in simple words, kept the auditor awake at night. So let's take a step back. We always say this, that, for certain areas and for certain things, we just do one procedure or 2-3 procedures and we get comfortable with. But there will be few of the areas which actually, to gain comfort, we need to do more and more, and which we will be thinking over and over as to what is to be done on this and how it is to be tackled and what are the things that I can do additionally to get comfort. These may not be matters which will actually call for qualification or EOM, but they are quite significant by basis of number. For example, something in, say, first time implementation of Ind AS 115. So identification of contracts, identification of various components of contract, then the warranty by buying in and all that stuff will require a detailed analysis and assessment, and there will be significant judgments also in determining how much revenue is to be recognized and when it has to be recognized. So that is something that, say for example, in an audit of 25 days, it took almost 6 to 7 days in deciding these things. So that's a significant matter, and the volume is also quite high. So that may be a matter of CAM. Though there are no specific observations there, there are no qualifications there, but this is an item which is large in itself and which is complex and which actually required a lot of significant judgment by the auditor. Also, providing for increased focus by management and TCWG on understanding of the entity, related disclosure, and also areas that have significant management judgment attached to them. So in the same example of Ind AS 115, which we said, in case there are few, assumptions that are to be made, because for revenue recognition, there will be certain points and checks as per 115 which have to be carried out. Also, there will be certain management estimates that will have to be taken into account. So those will be significant management judgment. Then it actually qualifies as a CAM, and that has to be brought out by the auditor in his report. This further, the intention is to encourage greater management engagement between the intended users of the financial statement, management, and the TCWG. That is the reason for which this standard was actually brought into picture. Few of the paras of 701, before we get into some of the examples and the ways to identify CAM in a financial statement. Para 11 of 701 specifically states, when you identify a CAM, auditor has to describe each key audit matter using an appropriate subheading. For example, heading may be impairment of intangible asset. It can be implementation of Ind AS 115, something of that sort. In a separate section of the auditor's report under the heading key audit matters, unless the circumstances in para 14 and 15 apply, which we will see later. Introductory language in this section of the auditor's report has to state key audit matters are those matters that in the auditor's professional judgment were of the most significance in the audit of financial statements for the year ended March so and so. That's the standard opening statement. So we know the placement of CAM, and this is how it has to be introduced. So this language is mandatory. We have to put out this language, and then we have to define the CAM, give a proper subheading, and then start the CAM. Further, we have to write, these matters were addressed in the context of the audit of financial statements as a whole and in forming the auditor's opinion thereon, and the auditor does not provide a separate opinion on these matters. Another important thing that has to be always remembered about CAM is, when we are writing a CAM and when we are writing an audit procedure, there are certain words which we are not supposed to use. We are not giving any individual opinion on one of the areas. Taking the same example, if we are talking about Ind AS 115, then it is why we consider this as CAM is important for us to note. So when we say that because of these factors, we identified this as CAM, and then we give the audit procedures. There, we are not in any way giving opinion on one of the area. We are just talking about audit procedures. We are just talking about the detailing of the matter. So there should not be any individual opinion on each of the area on which CAM is provided. That's very important to remember. We should not conclude that, okay, based on this, revenue is true and fair. We are not supposed to do that, because overall opinion will come in the opinion itself. Auditor's report, I mean. will come in the auditor's report, whether it is a qualified opinion, clean opinion, or otherwise. So that is something that will come across easily. And when we are talking about CAM, then individual reporting or individual conclusion is not something that we are looking for. Another important para 13 of SA 701, description of each key audit matter in key audit matter section of the auditor's report has to include a reference to the related disclosure. So everything that we have done has to have a cross reference with the notes to account or relevant accounting policy, whatever. In the same example of 115, there will be a detailed accounting policy and also disclosures as per 115. We can always refer to that note. So we will give a subheading, we will give a description as we saw, and then below that we will also give reference to the note to which in the financial statements. And it has to address why the matter was considered to be one of the most significance in the audit and therefore determined to be a key audit matter. So in the description, we will write why it was. So we will write the factors. Company is adopting Ind AS for the first time, Ind AS 115 for the first time. These were the factors because of which they had to make significant judgment. On the basis of above, we have concluded that this is a key audit matter. Okay, that is what we have to justify. We have to write the description and we have to write why we thought that this is a CAM. And then we have to write about how this matter was addressed in the audit, that is the audit procedure. So generally we write our audit procedures included. So various audit procedures like performed test of control, verified supportings, looked at the disclosures, adequacy of disclosures, so on and so forth. However, we have to remember that we are not giving individualistic opinion and we should not be concluding on any single matter over there. Para 14 of 701, which is also important. What does it say? Auditor has to describe each key audit matter in the audit report unless law or regulation precludes public disclosure about the matter. If there is any matter that any specific law or regulation actually has said that this should not be disclosed, if it has been prohibited or precluded, then that should not be provided. In extremely rare cases, auditor determines that the matter should not be communicated in the auditor's report because adverse consequences of doing so would be reasonably be expected to outweigh the public interest benefit of such communication. So this is not applicable if the entity has publicly disclosed information about the matter. For example, there is a highly sensitive matter which you have, which we as auditors have worked upon. However, by bringing out that matter in the public domain, it can cause more harm than good. So then that may be precluded from being disclosed. However, if that information is already publicly available, then this will not apply. These are very, very rare circumstances, as a standard itself says that in extremely rare circumstances. To prove that the disadvantages will outweigh the advantages will be something that will have to be determined and properly documented so that you can take the step. As of now, in these 4 years, we have not heard of any such thing, and neither the law or regulation precluding certain matter to be disclosed. These things are rare circumstances, but if these things are there, then it is not necessary to disclose the CAM, which is very, very rare. Another important thing is interaction between descriptions of key audit matter and other elements required to be included in the audit report. What does this mean? If there is a matter on which there is a CAM, and then if there are other elements that are actually part of the CAM, for example, if there is we were talking about in Ind AS 115, that is revenue, and then based on that, if there is any impact on the accounts receivable, and then there are certain things that are done in that area, so the interaction between these have to be properly matched. Let us look at a step-by-step approach to determining the CAM, which is very important and which we have to keep asking every time when we are actually looking for CAM. One of the things I would like to point, no offenses meant to anyone, however, we should refrain from copying CAMs from other financials or balance sheets, because each of the matter is completely different. We need to think about, we may use references, we may take references, however, we have to reword each of the CAM because as we know, every audit is different and every entity is different and everything has a typicality. So we need to actually think before we write, and we should actually do what is relevant, write what is relevant in the given circumstance. The same thing, the same matter may be there in another entity, but there may be a slight difference. We need to address that, and then we have to use that. What is a step-by-step approach to determining CAM? First, make a list of matters that are communicated with TCWG. So there may be hundreds of matters that may be, there may be, 10, 15 items that may be communicated with TCWG. So when we have that list ready, from that we are going to choose CAM, because that is what is something that is most significant. So when we do the audit, we come across queries, we come across various things, but not everything goes up to TCWG, because many of the queries get resolved. Some of them we drop it based on materiality, or which is below clearly trivial or something, and then we take up those matters with TCWG which are highly important. Out of the list of matters that are provided to TCWG, we will select CAM. So that list is your starting point. So that has to be seen thoroughly. Then out of that, we will then select matters that require significant auditor's attention. Means out of those 6-7 items, then what is it that actually needed as an auditor? What is it that kept me awake? What is it that needed significant attention of mine? That is something that we will have to look into. After that, the next step is, what is the matter of most significance to the audit? That is the funnel in which you go down and narrow down how to determine a CAM. So what is step 1? From the matters communicated with TCWG, we have to determine those matters which actually require significant attention from us as auditor. And then we have to see in the context of the entity and the audit we performed, and whatever we identified as per step 1, then we will identify what is more significant to the audit to arrive at CAM. Okay, so we may have 7 matters, for example, which are actually discussed with TCWG. Out of that, we have to sit and think as to what is it that required my attention. So maybe it comes down to 5. And then from that, we will then decide what that is most significant to the audit and to the audit as such. Then that may come down to 3. That is how we determine what is CAM. So decision stage and what are the factors to consider. So matters communicated with those charged with governance, making a list of it. So number of ISAs, actually not only 260, you can say 240 also, 320 also, which is actually 240, which is susceptibility of financial statements to fraud. Then risk assessment 315 also looks into certain matters that are to be mandatorily communicated to TCWG, independence matters, and so on and so forth. Number of ISAs actually include requirements to determine nature, extent, and timing of matters that are to be communicated to TCWG. That's mandatory. In addition to all those, we have a complete appendix in which in 260, in which all the matters that are to be communicated to TCWG are provided. So just as a working paper, what we should do is we should have a list of all these matters that are there in appendix 1 to SS 260, and then from different ISDUC as well as the matters. So everything we have a list, and then we see out of this what are the matters that we are actually taking to the TCWG. So once we have that list ready, then only we can actually go ahead. As we discussed, step 1 is take that entire list and then determine what are the matters that require significant auditor's attention. So we have to look at 3 specific types of matter as per 701 here, when we are determining what are the matters that require significant auditor's attention. Number 1, areas of higher assessed risk of material misstatement or significant risk identified in accordance with SA 315. So let's dwell upon this for a minute. SA 315 asks us to do a risk-based audit approach. We identify audit risks, then we identify assertions, then we look at whether it is entity level risk or it is assertion level risk, that is area level risk, right? Out of that, then we decide whether it is a significant risk or a normal risk or no risk. So whatever is significant risk, higher risk in other words, which we have assessed for the material with respect to the financial statement. So what is highly susceptible for material misstatement with respect to the financial statements? Those areas of high risk or significant risk is one of the aspects that we considered what required my significant attention. I have a list of TCWG points. Out of that, what required my more attention? Number one, where I have significant risk, audit risk. Second is where significant auditor's judgment relating to areas in financial statements that involve significant management judgment, including accounting estimate that have been identified as having high estimation uncertainty. Let's understand this a little bit. There will be areas. Number one, we all know that there are estimates that are to be made, few estimates that are to be made to prepare the financial statements by the management. When estimates are made, there will be assumptions, there will be significant judgments. If there are areas where there are estimations and there are uncertainties involving the estimation, and management has to do a significant degree of judgment, exercise significant degree of judgment, whether it can be an accounting estimate or an estimate in general for making some provision or other things, then where is it that it is actually having a significant judgment by the management, that we will have to determine. And whether on that me as an auditor has to spend more time or we have to exercise additional judgment is something that we will have to look into and determine those areas. To simplify this, for example, point number one, I have 3 to 4 risks in my audit. One is management override of control. Second is fraud risk in revenue recognition. Third, maybe say it is a manufacturing entity and it is, inventory is turning obsolete very fast. Fourth, maybe my warranty provision, for example. So these may be different types of risk that I'm having. Out of which is the one that I have a significant risk, that will be selection number one, parked selection number one. Second, estimate, for example, warranty provision requires management estimate, which also requires auditor to evaluate management's estimate or the judgment. So that may be point number two. That is how we will step by step keep collating the items. Then the third kind of matter will be significant event or transactions that occur during the period that has a significant effect to the audit. Simple example is that the company has applied for merger or demerger and that order has been passed or is in due process or something. We always give a detailed note to that effect. That may be a matter of CAM. Okay, so these are kind of thing. One is significant risk or higher assessed risk of material misstatement. Second is where auditor needs to exercise more judgment because management has already exercised more judgment in terms of accounting estimate or judgment or anything. Then third one is significant event or transaction that has occurred during the period which has a significant event effect on the financial statements or on the audit. What is step 2? Matter that are most significant to the audit. So we collated these items which are actually significant to me as an auditor, which required auditor's attention. Now, what are the matters that are significant from the audit angle? So factors for consideration when we are determining these matters that are in the judgment of engagement team, which are of most significance, are like significance of interaction between engagement team, management team and TCWG. For example, there is a matter. Say, let us take one of these only. We were talking about warranty provision in point number B. So when we are talking about warranty provision, it's not so easy to calculate and things like that. There are past estimates that we have to look into. There is trend analysis that we have to look into. How much spares were used, for example. What are the things that were involved in providing the warranty? What is the service cost? What is the sales cost? So on and so forth. So there had been frequent interaction between management, TCWG and the engagement team. So combination of significant judgment plus significant auditor's judgment that required auditor's attention and then which is significant to the audit, and the number is also quite large, that makes me identify a key audit matter. Next category is like importance of the matter to understanding the financial statements as a whole, particularly the impact of investors and other users understanding. So importance of the matter to understand the financial statement as a whole, for example, in DAS 115 implementation, which we have been talking about. So there are assumptions in doing that. There are certain change in policies because you're doing it for the first time. So those will be necessary to understand the financial statements, and that has required significant auditors attention also, because that will be a significant risk. So that will fall into item number A there, and also second number over here. Materiality of the matter, these things, if they are quite material, then obviously it will be part of the CAM. Nature and extent of corrected and uncorrected misstatements associated with the matter. This is very important. If the uncorrected misstatements are quite large, then that doesn't mean that you can give only CAM. If it qualifies for a qualification, you will have to give a qualification. Here, what it does mean to say is that what is the nature of total corrected, uncorrected misstatements that are associated with the matter? Means what is the technicality of whether it goes wrong or right, then what is the impact on the financial statements? It's not that if you have too much of errors in that area, then you can give a CAM and sit on it, because we have to give a qualification in that case. Further, a few of the things that will be, what will be significant to the audit: complexity of the accounting policy. For example, if the accounting policy is quite complex in a certain area, in say some provision or something, the calculation of the provision is quite complex, then that would actually require a significant auditor's attention, and it is of significance to the audit. Also, nature and extent of audit effort taken by the engagement team to address a particular matter. So this we spoke about. Maybe we are actually getting extended procedures done. We have spent a significant amount of audit effort by the put in a significant amount of audit effort to determine a certain matter or to close a certain matter. That is where it will be requiring significant auditor's attention, and also it is of significance to the audit. Next thing is difficulty of performing audit procedures, including obtaining sufficient appropriate audit evidence, evaluating result, and challenging subjective judgments. Now this again, like the last item here, should not be confused with qualification. This is the intent in which it is written. So CAM you can give only if you are able to get a comfort over the matter. If you have not got appropriate evidence, if you are not able to conclude on audit procedure, if you are not able to challenge the judgment, then it becomes a qualification under the respective standards, accounting standards. However, you are able to obtain these, but then you had some amount of difficulty in performing these audit procedures. That is when you had to put additional effort in the nature and extent of audit effort that you have to be taken. Then it becomes a CAM. If these things are not available at all, then it may become a qualification or disclaimer of opinion. Existence of severe control deficiencies related to the matter. Now we have two parts to it. Number one, we have IFC report. Generally in laws, so for all listed companies, the IFC report is applicable. If there are severe control deficiencies in the given area, it will be a IFC qualification for sure. However, once it is a IFC qualification, then we have done significant audit procedure. We had some difficulty in getting it. It is a matter of significant audit importance. However, if we got comfort, then it will become a CAM. If we still have not got comfort, then from IFC report, it will flow into the main report as qualification. Also, if there is a matter with multiple audit implication, that will also become a CAM. So just a quick recap. We have these matters that are communicated with TCWG. Out of that list, we determine whether it required significant auditor attention or there are matters more significant to the audit. When we are saying that it is significant to auditor's attention, then it is high risk, significant judgment by auditor because there was significant judgment by the management, and then significant event or transaction that has occurred. And in case of significance to the audit, then it will be frequent interaction. It is very important from the users of the financial statement. Materiality, corrected, uncorrected misstatement to guide you. Complexity, amount of effort that are taken. Difficulty that you have faced in performing the audit procedure in case of control deficiencies, and also matters with multiple audit complication. After doing all this, you determine that, okay, this is my CAM, and then you put up in your audit report. Few examples of typical CAMs. Number one, impairment issues regarding intangibles. That's a normal, that's a CAM because that involves a lot of estimation. Sorry, that involves a lot of estimation, because when you have impairment indicator, whether under Ind AS or AS, then you have a lot of estimates, judgments, the cash flow, future cash flow generation, and how it is happening, discounting, and all that comes into picture. So there will be a lot of subjectivity involved, and also if necessary you will have to go for expert opinion like valuation and things like that. So all that are involve a significant audit effort as well, and the matter will be important. So it may be a typical example of CAM. The deferred tax issues, for example, valuation of deferred income tax position or deferred tax asset. In certain cases, if there is continuing losses or something, then how to justify recognition of deferred tax asset. That may be very complex in case of some tax holidays and things like that. Determination of DTA, DTL may be a complex issue, and that's why it can become a CAM. Another, matters connected to restructuring or judgments, acquisition of entities. This we spoke about as we gave the example, merger, demerger, restructuring. Then accounting for pension provisions. At times, these are complicated, and if the entity has those kind of superannuation pension schemes, and then if that is under a trust and you are actually valuing it, either consolidating based on your standard requirement, those may become matter of CAM. Accounting for financial instrument. Yes, this is very much a detailed analysis that everyone does, that what is the standard and what is it that is applicable to me, and how we have valued, whether it is valued through P&L, whether it is valued otherwise. So a lot of complications here, so that may also call for a CAM. Valuation of illiquid assets and liabilities, that again may need for a CAM, because this may be complex matters, because readily available market value and things like that may not be available. You are seeking an expert opinion with respect to that, and you will be spending a significant time and effort there. Valuation of accounts receivables. Say, for example, in case of a bank, there may be this IRAC norms in terms of advances, where you have to make provision based on tiers and then NP recognitions, and these undergo complex calculations. Also in terms of normal account receivables, you may have ECL calculations. ECL itself requires a lot of underlying calculations and assumptions to be made, so that may be a matter of CAM. Then industry-specific accounting treatment. For example, 2 years ago, there was a moratorium granted to banks, so this became an important matter, and that may be a CAM. If one of the industry, for example, is getting subsidies from the government, and these are very typical to that industry, and you have to exercise judgment in determination of that subsidy. Management is also using some legal opinion and things like that to determine those subsidies. Then it becomes a matter of CAM. So these are like few of the generally typical CAMs that we see. Another one may be significant risk related to fraud in revenue recognition. I think this is the most common one which we see, that there may be significant risk related to revenue recognition, and that's why it has become a CAM. And few other revenue recognition issues, not specifically fraud and whistleblower, as we know, has a separate reporting available. Any other revenue recognition issues, complexities, accounting complexities, determination complexities, all those will come into this category. Management overhead of controls, how you have checked it, also, that can become part of CAM. Insufficient segregation of duties. Now, this is example of that failure of control, if that is that can be qualified in IFC. However, if you got comfort, then it will become CAM. Otherwise, it may get qualified in the main audit report also. Dependency on information technology, that can also be a CAM. Why? Because information technology, IT resources may be very complicated. They have multiple applications. There are interfaces that are happening. There is batch processing that is happening. A lot of things that are happening there, and or there may be instances of migration of data and things like that. Then it can become a CAM. Now, in all these cases, which I gave an example, if there are negative attributes, obviously that may become a qualification either in IFC or in the main report. However, if you have got comfort over these areas, then it will become a CAM. Few of the other considerations under CAM, identified CAMs are what? Specific to the nature and activities of our client. So number one, it cannot be generalistic. So just writing on the basis of, okay, this has been done in the client is not appropriate. We have to get into the details. For example, inventory in this client is getting obsolete, and that is why valuation of inventory on a specific date involves certain expertise, management, judgment, blah, blah, blah. And that is how it has to be specific. It cannot be generalistic. It has to be relevant and meaningful to users. By reading the CAM, one should understand what is the purpose, why is it written, and it is to be relevant to the financial statement. So generalistic ones should be avoided. It can be generally considered from the planning stage onwards, because when we do identification of risk, when we do a risk-based audit, as per 315, SA 315. So you are identifying your risks. So few of the significant risks that are identified and classified as significant risk or high risk actually inculcated into a CAM. They get converted into a CAM. So the journey will be, you identify a risk and then it is determined to be a significant risk. You do control assessment against it. You do, other substantive procedures against it. There are material items that you want to discuss with TCWG, you put this as this is a material item. You have spent enough number of time and effort on it. So obviously, ultimately, it satisfies all the criteria and it becomes a CAM. That's the general flow of a CAM. However, during the audit also, you can come across a big ticket item, which can become a CAM later on. What is not a CAM generally? Now, this is not a thumb rule. However, it is generally boilerplate discussion. So you can't keep something open-ended in a CAM that you have not got comfort, you're asking public opinion for. Those things cannot be a CAM at all. Discrete opinion for each CAM should not be given, and that is like area-wise opinion as we discussed, and it is never a substitute for a qualification or a disclaimer or a disclosure in the financial statements or an EOM. So something that management has not disclosed, I will disclose it as CAM. No, it's not permissible. Something I wanted to do a qualification, let me do a CAM, not permissible. Something I want to do as an EOM, let me do it as a CAM, not permissible. It's not a substitute for reporting a material uncertainty related to going concern in the auditor's report. We all know there is a specific standard SA 570. There is a placement in the audit report for material uncertainty on going concern, and that itself requires a lot of evaluation. CAM is not a substitute for material uncertainty at any point in time. CAM is not something that are matters unresolved by the auditor. If matters that are unresolved by the auditor, if they are material to the financial statements, then they are definitely qualification or disclaimer as the case may be. It can never be a CAM. Each CAM description must always include what is the essay requirement, the description of the key audit matter, which is a statement of fact. Usually this will include title of the CAM. For example, impairment of intangible asset. So we have to then, for inclusion in the auditor's report, we can then frame the description. Why did the audit focus on the matter? So an example is put out here. Identification of impairment events and determination of this is a complicated matter and all. And what is the reference to the related disclosure? You can always say refer note number so and so, disclosure number so and so, and things like that. This is how ideally a CAM is written. So just giving a brief illustrative CAM. What is the description of the CAM? This becomes the description of the CAM. Then impairment testing of goodwill is the header, and this is a complete description, and then reference to the related disclosure as well. So generally, this is the way the CAM has to be written. Describing the audit procedures to address the CAM, one of the important things is that you have to write audit procedures to address the CAM. Option 1, what is the audit response or approach that is most relevant to the assessed risk of material misstatement? So how did you audit this area? So some of the things that you have done here. So generally we start with the heading. Amongst other procedures, our procedures included. Yeah, our procedures for this area included so and so. So it's always an inclusive list. It's never an exclusive list. Please remember that. And then what is the most relevant procedure? You don't have to write everything, but you have to write what is more relevant and what is more understandable in a crisp and nice manner. We can also write a brief overview of procedures performed, a little bit para style. That's also permissible, but generally pointer style is what is generally followed. Indication of the outcome of the auditor's procedure, that's also possible. So you should not give an opinion, but you can say that we performed this, we concluded this, but we should never say that this is our opinion on this matter. And also key observations with respect to the matter can also be given, and a combination of all these can also be given. That's how you're going to write your audit procedures. So what can be done and what cannot be done? Description of how the matters address the CAM and wording that could indicate an opinion has been provided. So these are things that we should not be there in your audit procedures. So we are satisfied. So you should not write something like we are satisfied, because you are giving individual opinion. You cannot say something like this seems to be appropriate, or this is concluded to be appropriate. So these words that are outlined, underlined, bold, these are things that you should apply. These are things you should avoid completely. Something like the judgments that are done by the management are acceptable. Don't use such words. Also appropriately disclosed. No, we generally write that adequacy of disclosures have been verified. And also business combinations, for example, we concur with the management. So don't use all those wherein it can be seen as an individual opinion. Few of the things that you will write is tested, verified, checked, compared. So those are okay. Generally, we avoid using words like checked and all. We used verified, compared, performed, and things like that. Other considerations when writing a CAM, example of auditor reporting innovations, in terms of writing CAM presenting tabular formats. It can be in descriptive format, it can be in tabular format. If there is more than one, it is many people put it in table. Some of them even use graphical approaches. This is less seen in India, but then outside India, this is seen, for example, year-on-year comparisons and things like that. Few of the CAMs are, there will be, if there are 2 to 3 CAMs, then there will be a heading like recurring CAM, and then event-driven CAM. There will be a distinction between them, and that will be presented. That's also fine. Audit forms also disclosing in the CAM section what and how these matters have been reported to the audit committee or those charged with governance. So these are all different ways or innovations of how a CAM is reported. But then what we saw earlier is the bare minimum. These are additional approaches that you all are free to use, which is not prohibited by the law. Very important. We always say what is not documented is work never done. So for us, we do not have a tangible product that we give at the end of the service, because we are doing audit here. And for us, documentation is the savior. So we have to document everything that we do. And the mother standard for documentation is SA 230 audit documentation. From 230 also, and from each of the standard also, the documentation gets triggered. So what we have to document in terms of CAM, our rationale for why we determined that certain matters were CAM. So there were 6 matters. We said we took an example of 7 matters. Out of that, we came down to 5, then we came down to 3. How did we determine these 3 to be CAM? That is something that will be very important to note and very important to process. We have to document why we determined that these are the matters that are CAM. If applicable, why we determined there were no CAM. Now, one of the important things about the standard is that if you don't have a CAM, you have to give a statement that there are no CAMs in the financial statements in this audit report. So you will have to make that negative comment also. If there are no CAMs, you can write that there are no CAMs. So a few of the actually there's a tendency to think there has to be something. No, it's not that way. If there is nothing, then you can say that there are no CAMs in the financial statements as such, in this report as such. So there is a standard statement for that also, but you will have to say that there are no CAM. If you don't write that, then that is wrong, but then you will have to write it if it is not there. If you have determined that there is no CAM, then you have to document why did you think that there is no CAM? What made you think that there is no CAM? So it's not prohibited, but then you have to document yourself. Also, if applicable, our rationale for not communicating in the auditor's report a matter that we have determined to be a CAM. If you remember para 14, it said that if there is a law or regulation that precludes you from doing, or if it does more damage than doing good, then you may not have to report a CAM. So if that is the case, then you will have to document the entire rationale why you did not actually take it to be a CAM. So anyways, you have to document what did you think of. Few of the, this is not a FAQ published anywhere, but few of the things that we thought, has to be, it's a ready kind of FAQ that everyone, everywhere it comes to mind. Which audit it is mandatory to? It is only mandatory to general purpose financial statement. Please understand, it's never applicable to special purpose financial statements. So group reporting and all, it won't be applicable. It's only statutory financial statements in India it will be applicable to. Date of applicability, we all know financial statement starting on or after 1/4/2018. So date of audit report after 1/4/2018. Is it applicable to LR? No, it's not applicable because it's only for general purpose, and that too for the audit and not for limited review. Interim financial statements when we prepare and we give a limited review report under SRE 2410 or 2400, then this is not applicable. Whether early adoption is permissible? No, it is not permissible. As of now, there's nothing left for early adoption, but it was never permissible as an early adoption. Whether it is applicable to tax FS? As such, it is not applicable to tax FS if it is exclusively prepared for tax and not as a general purpose financial statement. If it is prepared as a general purpose financial statement, which is also going to tax authorities, then yes, it is applicable. Applicability to listed companies? Yes. If it is having a listed status on the reporting date, it is applicable. If it is delisted during the year, at the end of the year, it is not applicable. Under the listing process, then also not applicable. If it is securities are listed outside India, then also it is applicable. So please remember this, because these are questions that actually come up often. What are the different types of opinion to which it is applicable? In case of disclaimer of opinion, no CAM, no qualification, no EOM, no other matter. Obviously, because you're disclaiming the opinion, you're saying I couldn't do anything. I don't know what is there in the reports, what is there in the financial statements. So CAM is prohibited. Qualified opinion, yes, you have to give a CAM if it is there, or otherwise a negative statement that CAM is not there. Adverse opinion, still it's applicable, because what is the matter of importance or significance. And EOM, if there is a report in which there is an EOM, it is applicable, but EOM is not a substitute to CAM, and CAM is not a substitute to any of this. That is very important to be remembered always. In case there is no disclosure with respect to CAM in FS, it does not relieve the auditor from the requirement of reporting. Even if it is not disclosed, you can disclose it and CAM, but it cannot become a substitute to disclosure. Whether it can be different for different years, definitely it can be different for different years, but generally it is similar. Different entities in same industry, very much possible to have different CAM because of the assumptions, estimates, and other matters used. Significant risk, whether every significant risk is a CAM? No, not necessarily. Each one has to be individually evaluated to determine a CAM based on auditor's focus and also on the significance to the audit. All matters communicated to TCWG, whether it will be CAM, again, no. Individually, it has to be evaluated based on the two factors we discussed. Whether it is possible that we don't have a CAM, very much possible, but we have to disclose the fact in the report that there is no CAM. Only qualification, whether it is possible, yes, possible, disclose the fact that there is no CAM at all. Going concern, whether it is a CAM, no, it's SA 570, separate material uncertainty para can never overlap with CAM, and it's not a substitute. What is the order of CAM? There's no specific order. You can put revenue first, impairment later, depreciation first, whatever you want. There is no specific order. Console FS, whether it is applicable? Yes. For it, it will be parent CAM plus component CAM. Everything together. If component also CAM is applicable. If it's not applicable, then it is for the parent. Joint audit, yes. Each auditor in their area and collectively in the audit report, because ultimately both the auditors are going to sign the audit report together. Reference documents, there is SA 701, the standard itself, implementation guide to SA 701, which is there. There is a WRC publication on anthology on CAM and other reporting in audit reports, which is actually a compilation of more than 300 companies, qualification, UIM and CAM. You can use it as a ready reference for drafting. For quick reference, it is segregated industry-wise, matter-wise, and you can easily search in it. So that anthology comes very handy and you can easily refer to. There are thousands of CAMs, thousands of qualifications, thousands of EOM in that one publication. So that's all I have to share. Happy to answer questions, if any.
Thank you, madam. Can you hear me, ma'am?
Yeah, hi.
Can you hear me?
Yes, yes.
Yes, ma'am. Thank you so much for wonderful deliberation. Please raised by the members. First question is, what should be the criteria for determining key audit matters?
Sorry, sir. Not clear.
What should be the criteria? What should be the criteria for determining the key audit matters?
What should be the criteria for
determining the key audit matters?
Okay. Criteria for determining key audit matters. Okay, sorry. So the criteria is make a list of all the important matters that you are discussing with those charged with governance, with the board, with the audit committee, and with the CFO, CEO, who is the management. So level by level, you will start discussing first with the CFO, CEO, and then with the TCWG, who will be the audit committee and the board. Make that list ready, and based on the significance to the audit as well as significance to the financial statements, those two categories that we discussed about, then please start determining all your CAMs, and then you will have to follow that step-by-step approach, and then you will be able to conclude that this is my CAM. So matters that require significant auditor attention, matters of most significance to the audit. When you combine both this and follow this step-by-step approach, you will derive into CAM, and then that you will have to document.
Is CAM applicable to only audit of listed companies or all types of audits?
No, it's only applicable to listed companies as of now. It is not applicable to anyone else, and that I had put it up in the FAQ also.
One member is asking to throw some light where EOM and CAM be given for some same matter or not.
Yeah. So that's an important aspect. Rarely, there can be a circumstance which a matter can be an EOM as well as CAM. So actually, implementation guide also talks about it. But to determine that the same matter is an emphasis of matter, also a CAM, is a very difficult stance. Rarely in these 4 years, looking at so many companies, I've come across only 1 or 2 instances where the same matter is an EOM as well as a CAM. How a matter can be EOM and CAM? Emphasis of matter 706 actually talks about when a matter can be emphasis of matter, which says that it has to be a matter that has to be of significance to the users of the financial statements to understand the financial statements. If you determine it to be so, and then it had all these characteristics of significance to the audit and to the auditor, then only it will become a CAM and a UM, but it is a very, very rare circumstance that it can be the same matter can be UM and CAM.
Yeah. In case of a company is no more going concern, what sort of disclosure to be shown in the auditor's report?
So if there is a material uncertainty of going concern, then as per 570, you have to put up that pair of material uncertainty of going concern there. And if you strongly feel that there is no evidence to continue that company on going concern, then it goes for a adverse opinion, as the case may be, if it has to be prepared on liquidation basis, but the company has prepared it on going concern basis. Otherwise, the proper disclosure has to be given in the note. Also a proper disclosure in the auditor's report as per 570.
Yes. One last question. A partnership company has recorded investments in the subsidiary company, but has not effected the payment consideration, as the registration formalities are in the process and the formalities in official records are still in the process. The consideration is credited to the partner's current account. How is the auditor to report this well-intended transaction?
So prima facie, if it's a partnership firm, the CAM is not applicable to them. And if you're talking about reporting per se, if there is wrong accounting, then it amounts to a qualification. But what I understand from the query, it's like directly credited to partner's account. It may be a matter of EOM just by the description. I don't know the details of the matter. It seems to be an EOM apparently.
Yes, ma'am. So, ma'am, now we are come to the end of the first technical session. It was wonderful experience to have you on this today's VCM on key audit matters related to the independent auditor's report. You have covered almost all the things and all the implications relating to SS 701. So, on behalf of AASB of ICI, I extend my heartiest thanks towards you for sparing your valuable time. Thank you so much, ma'am. Moving towards the next technical session. SA 720 revised, that is the auditor's responsibility relating to the other information. We are having with us another eminent and learned speaker, CA Amit Hundiaji. So welcome you, Amit ji, once again on behalf of AASB of ICI. So without wasting much more time, may I request Amit ji to please deliberate on SA 720 revised also. That is the auditor's responsibility relating to the other information. Over to Amit ji, please.
Thank you. Thank you very much. Thank you, Padma.
Thanks, Amit.
My screen is visible?
Yes, sir, it is visible, sir.
Okay.
Make it full screen, sir. F5. Make it full screen, sir. F5. Yes, sir, it is fine.
Good evening. A very good evening to all the members and ASP team. And thank you very much for giving me an opportunity. And it's an honor and pleasure for me to give a presentation on this particular auditing standard to all our members of the organization. So today evening, we are going to discuss on the SA 720. We had a very good session from Padma Shri on CAM matters. So now on this SA 720, I mean, if we see what is the importance of this SA 720? SA 720 basically speaks about auditors' responsibilities relating to other information. So in normal sense, in a layman term, if I'll say more or less, everyone believes that auditor's responsibility is limited only with regard to the closure of financial statement. The responsibility ceases to exist once they sign off the financial statement and issue an audit report. However, with the issuance of this auditing standard, the responsibilities of auditors have increased, and over a period of time, this has again revised. So today we are going to discuss on SA 720, which is revised. These are the contents which we are going to cover today in our topic. It will be like applicability, objective, relevant phrases of SA 720, responsibility of auditor, respond, which is required to be given, illustrative reporting, and miscellaneous. So, members, as we know, this auditing standard got revised in 2018, and this became applicable from 1st April 2018. The revised one came into existence from that point in time. We are not trying to make any distinction here between the old and new because it's almost 3 years now with which this is into existence. So we are going to cover today on revised SA 720 only. Applicability, SA 720 is applicable to all entities. So when we say all entities means listed corporate and non-listed corporate. So listed corporate, if we see, I mean, I have presented here in a tabular format for the convenience of all, which will make it easy to understand. So if we see listed entities, all requirements are applicable of SA 720. In unlisted entities also, all requirements are applicable. However, there are non-corporate entities where normally we believe SA 720 is not required to be applied with. Whereas that is not the fact. SA 720 says that reporting requirement is not applicable in case of unlisted non-corporate entities. So when I say non-corporate entities, it means like, for example, partnership firm, LLP, or trust, etc. However, all other requirements other than reporting requirements are applicable to unlisted non-corporate entities. So what is the objective of this particular auditing standard? So the objective is to consider whether there is any material inconsistency between the other information and the financial statement, or other information and auditor's knowledge obtained in the audit. I mean, these two are very vast terms. Normally, we believe that we need to, or normally believe that they need to compare other information vis-a-vis financial statement. That is not the fact. The auditor's knowledge, which has been gained while carrying out the audit of a particular entity, is also required to be looked upon vis-a-vis information which has been shared in other information manner. So here, if we, so this is the objective here. And then second one is to respond appropriately when the auditor identifies that such material inconsistencies appear to exist, or when the auditor otherwise becomes aware about such information which appears to be materially misstated. So it talks about only and only material inconsistencies. It doesn't speak about all the inconsistencies. So again, I mean, as a normal principle, all the accounting standards and auditing standards are applicable on material transactions. What do you mean by other information? So other information is comprising of two parts. One is financial, other is non-financial. So again, here we should understand that financial information we can easily identify, we can easily track, and we can easily compare with the financial statement. Whereas non-financial information is something which is not appearing in my balance sheet or P&L, which has been signed off by me. So we'll discuss on non-financial information in our next slides. So these are the informations which are included in annual report. So we will also cover what do you mean by annual report, or what the standard says. I mean, here if we say misstatement of other information, so misstatement of other information exists when the other information is incorrectly stated or otherwise misleading. So either the information is wrongly stated, or any information which has been specified in the document is misleading, is not giving a correct picture of the financial information of the company or the business purview of the company. Annual report, the standard says, or standard has defined the annual report like this, that it is a document or a combination of document prepared by the management. So it can be director's report, which is signed off separately, which can be signed off separate, or it can be compositely combined, and it can be compositely issued to the owners or the stakeholders of the company. So for example, if we see, it will cover director's report. Annual report normally covers director's report, MD&A, secretarial audit report, corporate governance report in case of listed companies. So what do you mean by material inconsistency here? Material inconsistency is something like other information that contradicts audited financial statement would give rise to an inconsistency. The effect of an inconsistency is considered to be material if individually or in aggregate, it could reasonably be expected to influence the economic decision of the intended user. So if so again here there is no threshold of materiality which has been defined with regard to non-financial parameters. It's a judgmental call. One has to use their own professional skill, and then they need to come to a conclusion that whether any misstatement is material in nature or not. So example, if we see difference in amount reported as turnover in the director's report and as reported in the audited financial statement. So if there is a mismatch in the figure of the turnover, this is something which is not consistent with the financial statement, or maybe disclosure of remuneration of KMP in director's report mismatches with the figure shown in the financial statement. What is the responsibility of auditor here? The responsibility of auditor here is to read the other information and to consider whether the other information is materially inconsistent with the financial statements or the auditor's knowledge obtained in the audit, or otherwise appears to be materially misstated. So the first responsibility of the auditor is to go through the entire bunch of annual report, which is going to be issued along with the audited financial statement. The other information does not cover the financial statement. Other than that, it covers all these stuffs. Then it says then other information should be compared with the financial statement or the knowledge which has been gained by the auditor during the audit process. If based on the work performed, the auditor concludes that there is a material misstatement of this other information, the auditor is required to report that fact. So this is the responsibility which is casted on the auditor by SA 720. Further, the auditor's responsibility relating to other information apply regardless of the other information is obtained by the auditor prior to or after the date of auditor's report. So normally we believe, or we always have a question that we need to close the financial statement. For example, in case of a listed company, many times the audit committees are very close after the close of the financial year. So they may be in the 3rd week or 4th week of April. And by that time, the other information might not be ready. So the normal presumption is that we can just write in our audit report that the other informations were not available for our verification and has not been verified. However, standard does not give an exemption here. Standard says that the auditor should try to seek the other information prior to issuance of its audit report. However, if because of any reason the entire set of other information is not available prior to release of the audit report, it should be verified once it is ready after the audit report is issued. And it says that what are the processes which are required to be done in those circumstances. So the standard does not exempt the auditor if the other information is not available to the auditor prior to the issuance of report. It says even after the issuance of audit report, if the other information is available, it needs to be verified and vetted from the auditor's side. This is very, very important. One should remember this. One should not forget that once they have given a negative remark in the report that the information is not available, they can just skip from their responsibility. Further, the auditor has no responsibility under this essay to search for other information. The standard makes it very clear that there is no responsibility for the auditor that they need to search through various means, for example, looking into Google or company's website or other means of information. No, I mean, they just need to obtain the information from the company, from the management of the company, the entire docket of information which is going to flow along with the financial statement, and they need to verify that. Even they are not supposed to look into the website of the company with regard to the other information or which has been posted in the other electronic media. They just need to take the details from the management and they have to verify only such details. The auditor's responsibilities under this essay do not constitute an assurance engagement on other information and do not impose an obligation on the auditor to obtain assurance about the other information. So again, this is very important. Here, though the standard SA 720 casts a lot of responsibility on the auditor to verify the information which has been shared by virtue of other information in the annual report. However, it says that auditors are not responsible to give any kind of assurance on the other information which has been vetted or verified by them. These are some of the examples on auditors' knowledge operating the audit process. So like friends, as we have seen in our earlier slide, the other information is required to be compared with the financial statement. I mean, that's quite easy. It can be done. Apparently, it can be tracked. It can be verified. Any mistake can be noticed. However, auditors' knowledge, which has been gained during the audit process, should also be seen. I mean, this is one of the major change here. So if we see, for example, in the other information segment, or maybe like other than the financial statement, auditors, other than the financial statement or auditor's report, in the annual report, the company has made a mention that there are 20,000 employees who are working for the organization. Whereas when the auditor was verifying the entire financial statement data, they came to know that there are only 14,000 employees, for example, with regard to estimation for gratuity liability or bonus liability or payroll matters, etc. So then there is a big disconnect. So then auditor should look into this, that why there is a disconnect, and this can be gained by the auditor only. This knowledge can be gained only during their audit process. So another example is director has wrongly been represented as an independent director, and consequently this may result into non-compliance with SEBI listing regulations. So again, this can mismatch the entire composition or disturb the composition of the board or the audit committee members. Third example is a number of branches which are shown in other information is factually and materially incorrect with the number of branches whose operations have been considered in the financial statement. So these things can be knowledge can be gained or can be identified only by virtue of the auditor's knowledge, which has been gained during the audit process. So auditor should be very vigilant. I mean, the team who is going to verify the other information should be quite competent enough to catch those non-financial parameters and can understand that whether there's any material misstatement in the annual report to that extent or not. So once the material inconsistency has been identified, what should be done by the auditor? The standard says that the auditor should respond when a material inconsistency appears to exist or other information appears to be materially misstated. So the auditor shall discuss the matter with the management and if necessary perform other procedures to conclude whether a material misstatement of the other information exists, a material misstatement of the financial statement exists, or the auditor's understanding of the entity and its environment needs to be updated. So, friends, if you see here, there are three important parameters. One, if there's a material misstatement of the other information exists, I mean, what is stated in the other information, there is a disconnect. The auditor should communicate accordingly to the management. Whereas on the other way around, if there is a material misstatement in the financial statement, I mean, the other information is correct. However, there is a mismatch in the financial statement, which are yet to be approved by the auditors. Auditor need to take appropriate steps towards those matters. And the third thing, auditor's understanding of the entity and its environment needs to be updated. So here, if we see, the standard says prior to issuance of our audit report, if other information is obtained, and there is a material misstatement in the other information. So friends, please understand, please learn, there is no mismatch in the financial statement. Financial statement is correct. However, there is a mismatch in the other information, which is given in the annual report. This is the first part. So it says, the standard says prior to issuance of the audit report. So prior to issuance of the audit report, if other information is obtained, the discussion is required to be done by the auditor with the management, and it should be communicated to the management to rectify the other information. So in the first step, if the other information is getting rectified by the management, after it is communicated by the auditor, the matter gets sorted out. I mean, there is no need to do further reporting with regard to this in the auditor's report by the auditor. However, if the management refuses to rectify the mismatch or the material mismatch in the other information part, then the auditor is required to communicate with those charged with governance. Third step, so even after communicating with those charged with governance, the output is not successful, auditor has to take a step in that case. I mean, if the those charged with governance are also not agreeing with the misstatement in other information, then auditor should either make an appropriate reporting in the auditor's report or should withdraw from the engagement. I mean, this is the last recourse with the auditor. So either there has to be a reporting, or if it is quite severe, then auditor may decide to withdraw from the engagement. The second part. So the first part we have discussed that the other information has been obtained prior to issuance of the audit report. Now, in this case, if we see, the other information has been obtained after the issuance of the audit report. So as we know, I mean, as we have discussed in earlier slides, the standard permits to obtain or to collate the data with regard to other information even after the audit report has been issued, and it has to be audited by the auditor, it has to be verified by the auditor. So here in this scenario, again, if there is a misstatement in the other information vis-a-vis financial statement, so financial statement again here is correct, however other information is incorrect, so then auditor is required to communicate to the management. If it is rectified, matter gets sorted out, no need of any further reporting. However, if the management refuses to rectify it, then auditor should communicate it with those charged with governance. Even after that, if it is not getting rectified, the mistake, then the auditor should take appropriate action considering the auditor's legal right and obligations to seek to have the uncorrected misstatement appropriately brought to the attention of our users for whom the auditor's report is prepared. So friends, as we know here, already we have issued the audit report. So once we have issued the audit report, we have no control on that part. However, the standard gives a right to the auditor that if something which is materially misstated and it comes to the knowledge of the auditor through other information, and this is not getting rectified even after communicating with those charged with governance, then auditor has a right to look into the legal opportunities which are available with the auditor with regard to such kind of instances. So this is very important. This will be a rare scenario, but yes, I mean, there are quite few possibilities and it can happen. So one has to be very vigilant even after issuing the audit report. If the information has been sought for and received, then it should be looked upon that there is no misstatement, or if there is, it gets rectified. Now, there is a material misstatement of the financial statement. So if you see, we have discussed two scenarios. One is other information mismatch with the vis-a-vis financial statement, which was prior to issuance and after issuance of the audit report. Here, there's a material misstatement of the financial statement. So if the material misstatement in the financial statement exists, the auditor concludes that there's a material misstatement, then the auditor has to either change the financial statement or the auditor's understanding of the entity and its environment needs to be updated, and the auditor shall respond appropriately in accordance with the other essays wherever needed. Friends, this is the illustrative reporting which has been given in the auditing standard SA 720. So here I have just taken few of the extracts of the reporting requirement, not the entire reporting paragraph. So if we see the first paragraph, it says how it should be reported in case the other information is received by the auditor in parts or in piecemeal manner. That is, one part is received prior to the issuance of audit report and the second part is received after the issuance of the audit report. So it says, the standard says, or the illustrative format says, the company's board of directors is responsible for the other information. The other information comprises of the X report. So it says certain set of reports, but does not include the financial statement and auditor's report thereon, which we obtained prior to the date of this auditor's report. So the first phrase says that the other information comprises of the X report obtained prior to the date of this auditor's report. And then it says further, and the Y report, which is expected to be made available to us after that date. So there are two sets of information. One set of information is already received. We had made a mention. Another set of information is going to be received in future. We are making a mention of that this is going to be received by us in future. Then the another para says that if based on the work we have performed on the other information that we obtained prior to the date of the auditor's report, we conclude. So this paragraph speaks about the other information which has been verified by the auditor and obtained by the auditor prior to the date of this auditor's report. And if they conclude there's a material statement, they are supposed to report the fact. However, they have nothing to report here. I mean, this will be a factual statement. If they have nothing to report here, this will be a statement like this. Otherwise, the statement will get altered to some extent with regard to the last line of the second paragraph. The third paragraph says, when we read the Y report, so if we go back again to the first para, there we have stated about report X and report Y. So the third para says that when we read the Y report, if we conclude that there is a material misstatement therein, we are required to communicate the matter to those ones and describe actions applicable under the applicable laws and regulations. So it says that we need to make a mention. I mean, if it is essential, if it is required, if the complete set of information is not received, we need to make a mention like this. And then the standard says that this additional paragraph is relevant only in those circumstances where we have not received the information in totality prior to the issuance of the audit report. So friends, this is very, very important. I mean, there are a few formats which has been given by ICI in this auditing standard or even in the implementation guide. But the crux here has been presented, I mean, which we can see that how we need to take care where the other information is available prior to or not available prior to the issuance of our audit report. Friends, as we know, consolidation, I mean, consolidation again is very important. There are large groups many times having many SPVs within their organization. So the SA 720 requirement is applicable not only with regard to standalone financial statement, it is also applicable with regard to the consolidated financial statement. Normally, I mean, we believe that the components financials are being audited by other auditor. I mean, if, for example, if a company has 10 SPVs and out of 10 SPVs, 4 SPVs are audited by other auditor and 6 are audited by the auditor of the parent company. Auditor might take a view that, okay, 4 components are being audited by other auditor. So there is no need to take any responsibility, I mean, with regard to the financial statement figures, and which normally is also being described in the audit report in the other matter paragraph that these are audited by the other auditor and the auditor has relied on it. However, here the standard does not give an exemption. SA 720 says that though it has not been verified or the audit of the other components has not been carried out by the auditor of the parent company, the auditor of the parent company still needs to carry out certain processes with regard to that. So with regard to that, it says that the group auditor should use their professional judgment to determine when it is necessary to make inquiries of a component auditor in addressing the other information related to that component. So normally, as we all know, as a part of consolidation process, the auditor of the parent company seek details and information from the auditor of the component by sharing a group pack. It's a group questionnaire which is being issued by the auditor of the parent company prior to the commencement of the audit, on which the component auditors revert. So the auditor of the parent company can consider or can factor this requirement also as a part of group audit pack, through which it can seek the information, and based on that process, it can carry out the reporting in consolidated audit report. The group auditor is not required to state the fact. So the SA 720 is very clear. It says that the group auditor is not required to state the fact that he has not read the other information that specifically relates to other components. So there is a specific prohibition. The group auditor cannot write like this. So ultimately, the last step or the only step is that they have to carry out the entire process with regard to components also, and wherever they need, they can seek the help from the component auditor to vet or verify the information which belongs to those components in the annual report. Members, as we know, there may be a possibility that the annual report get translated in different languages. So maybe because of a regional requirement or a particular specific region, or maybe a requirement of any country. I mean, the annual report can get translated into other languages. So the standard has dealt with this particular requirement. The standard says that when the annual report is translated into other languages, pursuant to law or regulation, or it may be voluntarily translated. So for example, English से हिंदी में convert किया गया, या English से कोई दूसरी regional language में, या कोई foreign language में convert किया गया. So the standard says that if it is translated pursuant to any law or voluntarily, or when multiple annual reports are prepared under different legislation. So there can be a possibility that there are multiple annual reports because the entity is listed on more than one jurisdiction. It can be listed on BSE, it can be listed on London Stock Exchange, or I mean any other stock exchange. So it says that in those cases, a consideration may need to be given as to whether one or more than one of the annual report form part of the other information. This is very important. The standard says that in such circumstances, the judgment has to be taken by the auditor. I mean, the auditor is not relieved from its responsibilities. However, the auditor has to take a call, a professional judgmental call, and based on that, it needs to be evaluated by the auditor whether all these reports should be considered as a part of other information requirement or not. Local law regulation may provide further guidance in this respect. I mean, if there is a, if it's listed on a different exchange, yes, I mean, local law regulation may require it to consider in a separate manner. In this slide, we are going to cover about the applicability or the other parameters of SA 720, which is miscellaneous in nature. So SA 720 does not apply to securities offering documents, so including prospectuses. So I mean, nowadays we know a lot of companies are coming out with IPO. There's a boom in the market. So the DRHP is being issued. So DRHP is a complete set of document. I mean, it gives an exhaustive information about the company prior to its listing. So that information is also available in public domain. The auditor is required to issue an examination report in those situations on the restated financial statement which are included or incorporated in DRHP. However, SA 720 gives an exemption or excludes this, that auditor is not required to verify the other information which is captured into DRHP, or is not required to make any mention or to issue any kind of reporting on other information in the examination report. Then SA 210. SA 210. So again here, if we see before we accept any audit assignment, we are supposed to take the engagement letter. I mean, there's SA 210, which deals with the requirement of engagement letter and what are the terms or contents which are required to be covered in general in the audit engagement letters. So the auditor should be cautious enough. Auditor should take the requirement of this particular matter in the engagement letter. The auditor should get factor this other information requirement paragraph suitably incorporated into the engagement letter, which is going to be signed with, by the auditor and by the management. So the roles and responsibilities with regard to other matter will get captured in the engagement letter, and which is very clearly known prior to the commencement of the audit to the board of directors and those charged with governance, including the audit committee members. So this is very important. One should not miss it. I mean, one should see that the engagement letter covers the responsibilities of the auditor and the management with regard to the other information. Further, the standard says that the timely communication should be made by the auditor to the management. So timely communication means well in advance prior to the commencement of the audit, As we know, this reporting requirement gets triggered only in case of annual financial statement, complete set of financial statement. Because in case of quarterly review, this is not required to be reported, not required to be given. This is required to be given only in case when the annual financial statements are being issued and the annual report is issued along with the annual financial statement. So prior to the commencement of audit, I mean, it is advisable that prior to the commencement of audit, the auditor should communicate to the management that they will require the other information well within the time before the issuance of their audit report, so that they have suitable time to verify the other information. And if anything materially inconsistent comes up to the knowledge of the auditor, it can be rectified well in time. So timely communication is very important, because if it is communicated last minute, I mean, management may say that it's quite difficult to share this information as they are still under preparation. Then, friends, I mean, this is a very important thing, audit documentation. So there's a specific essay on that, essay 230. So audit documentation is very much essential with regard to what has been obtained by the auditor for verifying this other information. Whatever has been obtained has been appropriately verified or not. So the financial information part can be easily verified and easily documented. But in case of non-financial information, the auditor should apply its skills to know that the information which has been shared in the annual report is not materially inconsistent or incorrect, or is not misleading. So adequate backup should also be there on the work paper, on the working file of the auditor. So documentation is highly essential. And as we know, the standard is applicable to all the entities. I mean, it is relevant maybe for a small company or a large company, I mean, whichever size of the company may be. Then while reporting in audit report towards other information requirement, the standard says that in that particular paragraph, in the paragraph of other matter which is coming in the audit report, the auditor should specifically mention of the documents which are covered by the auditor for its verification. For example, director's report, MD&A, etc., etc. So it should not be vaguely stated that the other information has been obtained. The auditor should be quite clear that what kind of other information has been obtained by the auditor and what has been verified, so that it is very easily known to the reader of the financial statement, okay, that these stuffs are obtained by the auditor and are verified by the auditor prior to the issuance of the audit report, or maybe after the issuance of the audit report. In that case, the relevant requirements are, or relevant procedures are required to be done. Written representations. So again, this is very important. Other information, I mean, auditor will try to seek all the information, I mean, to seek all the material information which is being presented in the financial statement and get it validated with the financial statement. However, in case of non-financial information, auditor may not be able to get the complete set of data. I mean, sometimes it depends upon the MIS or other parameters. So it is very important for the auditor to seek appropriate representations in time and should get adequately captured all the relevant matters which an auditor feels that are required to be captured in the management representation letter. So again, this essay is very important. So if you can see, I mean, there are various essays which are getting interlinked, and this essay is also relevant from that perspective. The essay further says that if there is a modification in the opinion, so when we say modification means there can be a qualification or there can be an adverse opinion in the audit report. So if there is a qualification or there is an adverse opinion in the audit report, then other information is required to be suitably amended to factor that particular modification. So this is again very important. ICI has issued an implementation guide with regard to this essay. One can go through it. I mean, that is quite comprehensive. So after the issuance of essay, ICI came out with good questions, good FAQs, and which have taken care of most of the requirements, or which has cleared most of the doubts which one can have while reading the standard. So that is quite comprehensive and quite explained in a lucid manner. Further, there are various illustrations of reporting which has been given by ICI in the auditing standard and in the implementation guide. One can go through it. I mean, it will be quite handy. So it will cover the reporting requirement in case of standalone financial statement, in case of consolidated financial statement, modification in standalone financial statement, or modification in consolidated financial statement. So that will cover, I mean, various permutation and combinations, and that reporting requirement is, I mean, the reporting paragraph has been given by way of illustrative audit report in the auditing standard. That's all, friends. That's all from my side. I mean, thank you very much for the patience hearing and patient learning. I'll be happy to answer any questions. If anyone has anything to ask, happy to respond to that. Thank you very much.
Can you hear me? Amit sir, can you hear me?
Yeah, I can hear you.
Hanji sir, Hanji. Thank you, Amit sir. It was a wonderful deliberation. And there are two questions for you, sir. First question is, in case of listed companies, when annual report is only in draft stage at the time of finalization of March accounts, what should auditor write in other information paragraph?
No, so if the annual report is in draft stage, I mean, the auditor should get it certified by the management, should take it as a part of representation, should verify it, and if there is no material inconsistency, that is absolutely fine. However, before the issuance of the annual report, again, auditor needs to cross-check. So if there is no material inconsistency in that, that is absolutely fine, because the auditor has carried out the required procedure in regard to that, and that has been taken care of. But if anything which comes up in the final docket, then auditor will have to take suitable steps which are prescribed in the auditing standard.
See, in the same lines, director's report can be available only after audit report. If auditor points out material inconsistency in the director's report, which company does not want to change, how auditors can inform the shareholders about the same?
Yeah, so I mean, I have covered this in one of my earlier slides. So here,
Yes.
if there is a material inconsistency which is noted or observed in the other information after the audit report is issued, because this information is made available to auditor only after the issuance of the audit report, then the standard says that either, I mean, it should get verified, it should get rectified by the management. If the other information, so again, there are two things. One is there is material inconsistency in the other information. There is material inconsistency in the financial statement. So if it is there in the other information, auditor should communicate to those charged with governance. If it is not getting rectified, auditor should take appropriate step. Either it should get communicated to the stakeholders, various stakeholders through the appropriate mode, or auditor should exercise the legal options available with the auditor with regard to material misstatements which are there in the other information or in the financial statement. So then auditor may decide to withdraw himself from the engagement of that particular entity and may issue a public notice that auditor is getting withdrawn, or maybe, I mean, communicate to the appropriate stakeholders that through appropriate mode that they are withdrawing their audit report because of XYZ reasons.
Yes. Sir, is SA 720 revised applicable only to listed companies or to the private company also?
So, sir, again, I mean, I have covered this in very first slide of mine in this presentation. SA 720 is applicable to all entities. So, I'll again repeat here. So, when I say all entities, the standard says listed entities. So, listed entities by default, yes. For unlisted entities, yes, but when I say unlisted entities, the SA 720 had made a revision. The requirement is applicable in case of unlisted entity only to corporates. So corporates, so I'll go back again to this particular slide so it will be easy to catch. So here if we see SA is applicable to all listed entities, to all unlisted entities with regard to reporting requirement and about all the other requirements. However, in case of unlisted corporate entities, the requirements of this SA are applicable in totality except reporting requirement. Because as such, if we see there is no defined format for audit report in case of trust or in case of partnership form, I mean, this gets little bit different. So the reporting requirement is not there, but all the other requirements are applicable of SA 720. So it is, in short, it is applicable to all the entities, whether it is a corporate entity or non-corporate entity. In case of non-corporate entity, the reporting requirement is not applicable in nutshell.
So now it comes to the end of today's VCM, sir. Thank you so much. Once again, on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I again extend my heartiest thanks towards you also for sparing your valuable time, as well as acceding to our request on a very shorter notice to deliberate on this SAS 20. So, sir, thank you so much for sparing your valuable time. Thank you so much, sir. Thank you.
Thank you. Thank you. It's my pleasure. Thank you very much.
Thank you.